Okay, it's audible now. Let's begin. Okay. So guys, we'll start with the history of bonds. Bonds is very recent on stable money, but it's perhaps one of the oldest financial instruments available in the world. I think the first bond was issued in 1100 BC, what 30, 3300, 3200 years back. The first bond was interestingly cast in a stone. Anybody who held that stone would be the owner of the bond. And then the first government bonds were issued, I think, in 1600 or 1700 AD, like 300, 400 years back, were the first government bonds issued. And in India, the first government bonds were issued towards the beginning of 1900s. And after government start issuing bonds, uske baad corporates also started issuing bonds. In fact, Tata was one of the first institutions in the country to issue bonds and benefit from that. Let's talk about what a bond is, right? A bond is nothing but a standardized loan. So, for example, a corporate, let's say, want to take a loan. Abhi kya hota hai? So they go to a bank and say, ki, yaar, we want to, build this factory. So therefore, we need 1 crore rupees. Please give me this crore rupees. And once the factory is built, I'll pay you that, crore rupees back. And in the interim, each month, I will pay you 1% as interest. This is how typically a loan works, right? Between a corporate and a bank. Now, here the contract is only between two parties. Now imagine an alternate situation where the corporate says, ki, instead of taking that 1 crore rupees from the bank, they would say, let me issue 100 bonds. Each bond would be worth 1 lakh rupees, and anybody that holds that bond will be paid 1 lakh rupees at the end of the term of the bond. And for the duration of the bond, each bond holder would get a monthly or a quarterly interest, right? Now, what the corporate has done is they've broken their big loan of 1 crore into standard pieces of, 100 pieces of 1 lakh rupee each. And the beauty of this is now those 100 bonds can be taken by anybody in the system. It need not be a bank. It could be you and me. It could be some other corporate. It could be a bank, who can be holding that bond. And whoever holds the bond will get the interest. And these bonds also can be transferred between people. So, for example, when the corporate took that 1 crore loan by issuing 100 bonds, a person A could be holding all those 100 bonds. 3 months down the line, A must be holding 50. A new person has come in who is holding 50 more bonds that can get distributed into 100 people owning 100 bonds. So the transferability is very good in a bond. The diversification of the loan between players is very good, and it also helps the corporate to have multiple sources of borrowing capital. Now they're not just dependent on the bank to give them a loan. They can source it from anybody in the market. What this also does is gives them efficient interest rate on capital. So for example, if a bank says, I won't give you a loan below 15%, and the corporate has good image in the market, they could go to the market and maybe get at a 13-14% kind of rate. So that's the use case of a bond. And a bond can be issued by either government or corporates. And why does a government issue bonds? They can just print money and use that money, right? Why do they issue bonds? So if you look at the 2025 budget, which was launched, released a month back, in that, if you know the headline numbers, 35 lakh crores is what the government gets as revenue through taxes and various other initiatives, and 50 lakh crore is what the government spends. Now there is a deficit of 15 lakh crore rupees, right? This 15 lakh crore rupees needs to be funded by someone. That either can happen by printing newer notes, which would mean that there'll be high inflation in the system, your and my money would go down, or the government can say, hey, I will borrow this money from the market, use that to build infrastructure, or maybe to give out pensions, maybe to give out some agriculture incentives, etc. I'm borrowing that money so that it A does not bring in inflation, and B gives me that capital to have to spend that efficiently, which can give me future resources. So bond by the government is a cost on the future generations, because the future generations are going to pay for it, and gives the government enough leeway to build infrastructure which can support that growth into the future. And why do corporates, issue bonds? As we've briefly touched, for corporates, it is a diversified source of capital, not just from, banks. There are other institutions in the market that can, give this capital. And in corporates also, there are two broad categories, of corporates who issue bonds. One is NBFCs, the other is the regular corporate, which are not NBFCs. For NBFCs, capital is a raw material, right? These guys are lending out in the market, so they need that raw material to lend out. So, for example, what a Bajaj Finance today does is they give out these appliance loans, these personal loans, everything at 15-16%. But to give that loans, they would borrow capital from somebody else. That could be done by directly going to a bank or by issuing bonds. And because Bajaj Finance is such a well-known entity, such a reputed entity, they get loans and bonds at 7.5%. They lend that out at 15%, and the delta is where they recover the operational costs and make profit. So for NBFCs, it's a raw material. For corporates, it is more of a capex instrument, right? Again, somebody wants to build a factory, they would need money for that, and here is corporate bonds, which can offer as a source of capital to build that infrastructure. And by the time, within 2-3 years, this factory would start giving them higher returns, by which they can pay back the bonds. And for corporates also, they could be using either the equity route to raise money or the debt route to raise money. Equity would mean a dilution in the share of ownership. Equity would mean a constant tax on the profits that the company earns, because the profits that the company earns for perpetuity will go to the equity holders. But bond is a temporary liability. Whenever a bond is issued, it is issued for a given tenure, 1 year, 2 years, or 3 years. Us 3 saal ke liye you pay the interest, and after that you have your entire equity, you repay the bond, you have your factory up and running, and therefore is beneficial for companies which can efficiently use that capital. And let's touch base about the typical types of bonds available in the market today. The largest selling bond in India today would be a government security, or called as GSEC. These are issued by the government of India, typically have tenors from 5 years to maybe 50 years. And these are the safest bonds in the country, because when a government is taking money from you, there is no way that they will default. In the worst case, they will print notes and give it back to you. So the safest bond in the country is a GSEC. Today the GSEC in the country would be trading at a 6.5 to 7% kind of rate, which would mean this is the risk-free rate of the country. In India, if you were to earn money without taking any risk, 7% is what you can get, and that is determined by the government borrowing. That is GSEC. And the other face of GSEC is something called as T-bills. These are treasury bills, again issued by the government of India through RBI, and these have tenors of less than 1 year. So short-term capital ke liye the government through RBI issues T-bills. For long-term capital, you have GSECs. Apart from this, there is something called as SDL, which is a state development loan. A GSEC is issued by the government of India. SDL is issued by the state governments, right? The state governments, to fund their fiscal deficit, they issue these SDLs. These are managed by the RBI. The financing, etc., is taken care of, or at least they have this. They are under the watch of RBI. Therefore, here also the risk of default is very minimal, or almost close to zero. An SDL in India would today be at a 7.1 or a 7.2% kind of interest, which is slightly better than the government of India, but almost close to the government of India bonds in terms of risk.
So, hi folks, Harish, there are till here, right? There are, I think, 3 relevant questions. I think there's a lot of questions on safety and everything. We will be taking it in the next section. But I think first question, which Mr. Sushant asks, right? Who is regulating bonds?
So 2 kinds of bonds. The GSECs and the SDLs are regulated by the RBI. The corporate bonds are regulated by SEBI. So listed corporate bonds are regulated by SEBI. The unlisted corporate bonds are not regulated by SEBI, but those bonds do not come under the purview of website like stablebonds.in.
Okay. There's another question, I think, because you mentioned about government bonds as such. Do bonds in general give less interest annually?
As compared to?
I think that question is maybe as compared to like an FD or a savings bank account.
So the GSEC bond, the Government of India bonds would be the lowest interest rate earning, or perhaps one of the least interest rate earning instruments in India, because that's the safest, because there's no default risk there. But typically, there are bonds in India which would give you much higher, rates there than FDs. Uh, I think if you were to stack rank the percentage of bonds that would be paying you more than FDs, there would be 70 or 80% of bonds in India today which would be paying more than FDs. We'll come to that when we cover it in the next.
I think these two were the key questions which were there.
Got it. And in the type of bonds, the last kind of bonds is the corporate bonds. These can be issued by private companies, public companies which have gone IPO, or PSU entities. And a lot of OBPs, including stablebonds.in, have all these categories. And it's interesting, right? A publicly listed company has both equity available in the market and also a bond available in the market. Which one do you choose? So equity is a bet on the growth of the company, right? If the company grows, you would make money. And bond is a bet on the survivability of the company, right? So there could be a situation where we would say, a PSU entity might not grow at 10-15% every year. So the equity returns of that entity might not be very high, but we can be absolutely sure that this PSU entity would survive, given the ownership of the government of India, or given the image of it. Therefore, bond might become a better bet at that. Or there could be, publicly listed institutions which are growing at a massive rate, 20%, 30% year on year. There, the ideal bet to take is on the growth. Therefore, equity would be a better instrument for that. In the next slide, we'll talk about how does a bond work, right? It is very, very similar to fixed deposits in the country, right? When you purchase a bond, the money you transfer your money. It could be to the issuer of the bond, which could be the corporate, or it could be to the holder, the current holder of the bond. So if you hold a bond, like if you hold a fixed deposit, you get regular interest payouts and you get a principal repayment at the end of the term, right? Again, very apple to apple kind of comparison between FDs and bonds. Sorry. Just a second, guys. Okay, well, let me just try to show you the slides if this is in a better. Cool. So sorry for this, guys. So I think the bonds work very similar to FDs. You hold a bond, you get interest payouts every month. The interest payout would come to your own bank account, and at the end of the term of the bond, the principal also will come back to your own bank account. Very similar, to FDs as a concept. What are the important terms in a bond that one needs to know? Right, there are 3 or 4 most important terms that you would need to know when purchasing a bond. The first thing is the face value of a bond. Then there is coupon rate, there is tenor of the bond, and there is yield to maturity. The face value of a bond is the money that you get paid back as principal, for 1 unit of the bond. For example, when there is a GSEC, the face value is typically 100 rupees. So if you hold 1 unit of GSEC, when the GSEC matures, you get paid back 100 rupees. So 100 rupees is the face value of the bond. Coupon rate is the interest that you get paid on the face value. It could be monthly coupon, it could be quarterly coupon, it could be yearly coupon, which is the frequency of the payout. Coupon is the percentage that you get paid on the face value. Again, taking the GSEC example, For a 100 rupee face value bond, you get paid 6.7%. So 6.7 rupees is what you get paid back every year. So that is the coupon rate. The third interesting thing to understand about a bond is yield to maturity. Now let's say there is a corporate in the country which has issued its bond at 100 rupees and at 10% coupon for 5 years, and you purchase that bond. Now 1 year down the line, let's say the interest rates in India have collapsed, meaning RBI has reduced the repo rate. A GSEC which was being issued at 7% last year is now being issued at 3%. The bank interest rates, everything have collapsed. So there is going to be massive demand for a bond which will give you 10% interest rate, right? But this was issued last year, not this year. This year, all the bonds that are being issued at 7% or 6%. Now, the demand for the bond which was issued last year is very high. And how does that bond come into the market? Somebody who's bought that bond last year can come into the market and say, hey, I want to sell this bond. I had bought this for 100 rupees. I want to sell this. This is a bond that gives you 10%. Now, because the demand of that bond is so high, that bond, instead of selling at 100 rupees, will sell at 105 or 106 or maybe 110 rupees, right? Now, for a buyer who is purchasing this bond at 110 rupees, how do you calculate the interest that he's gaining, right? Because face value 100 rupees hai, coupon 10% hai, but you have purchased it for 110. So the principal that you get paid back is lower than what you paid, right? So iske liye there is a concept called as yield to maturity, right? For your purchase price, it could be whatever price. For a 100 rupee bond, you might have paid 200 rupees. If you have purchased a bond at 200 rupees and you get interest according to the 100 rupees that is the face value of the bond, and at maturity you get 100 rupees back, what is your implied rate of interest? That is called as yield to maturity. What this does is it standardizes all bonds, because it is going to be very tough to say ki this bond I am buying at 110 rupees. There is another entity's bond that I'm buying at 90 rupees. There is entity C's bond which I'm buying at 105 rupees. How do you compare these bonds? It can't just be on the price, because each of the bonds would be having a different coupon rate, would be having a different tenor. So to standardize the comparison between bonds, yield to maturity is bond, which will just compute what is the money that you have put in when you purchase the bond. It could be higher or lower than the face value. And based on that, and based on the payouts that you get, which are typically linked to the face value of the bond and the coupon rate of the bond, what is the implied rate of interest that you make? That is called as yield to maturity. And when you compare any two bonds in the market, the only thing that you need to compare is yield to maturity. And in the last example where we've said that a 100 rupee bond is now being sold at 120 rupees or 110 rupees, as the price of the bond keeps going up, the yield to maturity keeps going down, right? When a bond was issued, 100 rupees, 10% was the coupon. So its yield to maturity is close to 10%. But if it's sold for 120 rupees, maybe the yield to maturity is now only 7%. If it's sold for 200 rupees, maybe the yield to maturity is only 1%. If it's sold for 300 rupees, maybe the yield to maturity is negative. That is how it works. Next slide, please. I can't see it. Okay. The next question is why bonds? You have FDs, which are at the lower end of the risk spectrum, which are giving you now 9.5%, thanks to stable money, and there is equities to the other end of the spectrum where you take higher risk and you get maybe 12-13%, kind of returns. Why does one need bonds in their ecosystem? So bonds is that intermediate step between equities and fixed deposits, where your rate of interest is significantly higher than an FD. So, for example, on staplebonds.in, you could get 11.5 to 12% kind of bonds. There are other OBPs in the market also which would give you these kind of returns. So 1.5, 2% to 2.5%, higher rate of return than fixed deposits. And also these are safer than equities, right? In equity, as we've seen in the last 1-2 months, the markets have fallen by 10-15%, right? So that risk is not there when you purchase a bond. So 3 or 4 major reasons of purchasing bonds. One is higher payouts, higher returns than an FD. There is a whole bunch of bonds available in the market where you can choose between payouts. It could be monthly payout, quarterly payout, or on maturity payout. You have a stable income now where your income is defined that every month I'll get income at this point, this amount or this interest rate, and you have a tenor that is fixed and is less riskier than equities. So bonds is a step up in investments for those who've only been doing FDs, and for people who've been doing equities and FDs, bonds is that intermediate layer that gives you the flexibility to choose between risk and return range.
I think, Harish, there are a couple of questions which have come in related to the sections, right? And like everyone, folks, bond rating, how does it work? Safety, everything will be answered in general. Swarnava Adya asks, major difference between FD and GSEC is if the FD withdrawn before maturity, a penalty is charged.
Yeah.
But in case of GSEC, it can be sold anytime in the secondary market.
That's true, but the key difference here is, so FD, let's say you purchase an FD at 9% and you prematurely withdraw it. So there is a penalty A that is applied, and B, there is a defined interest rate that the bank would say that, let's say you purchase an FD for 3 years and sell it 2 years down the line. The bank will look at the 2-year interest rate of the FD, apply a penalty, and then give the rest to you. In terms of GSEC, let's say you purchased a GSEC at 7% and 2 years down the line you are looking to sell it. It will sell at the applicable rate, the trading rate at that point in time in the market. So there is no defined rate that you will get. So at that point in time, 2 years down the line, it could be selling at 5% in the market or at 9% in the market. So your return on that GSEC is dependent on how the traded markets work in GSEC. That's okay.
And Rahul, since you've been asking for rating parameters, etc., that's the next section of how safe are bonds, right?
Yeah. Okay, so how do you determine the safety of a bond, right? We said bonds is less riskier than equities, higher return than FDs, which means there is some kind of risk involved, right? FDs practically today with the DICGC insurance is almost risk-free. And given the talk about a rise in the DICGC insurance limit that is going to come, there is 9.5% kind of risk-free limits, risk-free interest that you could make via FDs. But in bonds, there is definitely a risk that you need to be wary of when buying a bond, and there are a few parameters that you would need to look at before buying a bond. And a thumb rule in the market is, if there is a bond which is offering you insane returns, anything that offers you 13, 14, 15%, that is only because there is a risk associated with it. So do not get interested into bonds that give you 15, 20%. These typically come with a 5 to 10% kind of default risk. So when you analyze a bond on what to buy, there are 3 or 4 parameters that you need to look at. One is the credit rating. So credit rating is very similar to CIBIL score, for us, right? When you go to, let's say, get a home loan, if your CIBIL is above 700, you get a home loan at maybe 8.5%. If your CIBIL is at 600, maybe you'll get at 9.5%. Your CIBIL is 500, maybe you get at 12%. If your CIBIL is below 500, you don't get a loan, right? A very similar thing, that is applicable for corporates in the country is something called as credit rating. And here, in terms, in place of a score, we have something called as rating, right? So the top-notch rating is a AAA rating. AAA would mean the most pristine, bonds available or entities available in the country, and there is near zero chance of default for these entities. A typical example of a AAA rated company could be something like a Tata Capital or an HDFC Bank or a Bajaj Finance. And a notch below AAA is AA rated. Again, these are very safe companies where almost the risk of default is also close to zero. A Shriram Finance or a Muthoot Finance, might fall into this category. And a notch below AA rated is A-rated companies, something like an iFinance or a Crazy Bee, fall into these. And AAA, AA, A are the safe categories. After that, you have the moderate, risk categories where you have BBB and BB. And then you have C and D. C and D are close to junk kind of bonds where the default rate is very high. So again, as I mentioned, A-rated and above bonds would have much lower risk than a triple B or a B or a C-rated bond. Okay, so who rates these bonds? For example, when a CIBIL score is given by a company called CIBIL, for rating also there are agencies. There are agencies like CRISIL Rating. There is agency like ICRA, India Ratings. There are multiple, such rating agencies in the country that rate these bonds, and they also have a stack rank, right? Uh, so the next So in India, I think the most popular ones are CRISIL, which comes at the top. Then there is ICRA, there is India Ratings, and there are CARE Ratings. These are the four rating agencies that rate the corporates. And any listed bond in the market can only be listed and issued if there is some rating given by one of these rating agencies. So on stablebonds.in, if you are looking to purchase any bond, there will definitely be a rating, and most likely a rating by one of these four agencies in those categories that I had just mentioned. So how do we understand ratings? So I think the scale is one thing to see, but how does the scale translate into numbers? So here is an interesting study that is done by CRISIL. What they've done is they've looked at the last 10-year history of the bonds that they've rated, and they've looked at the default probability or the number of times such bonds have defaulted. For example, on AAA, they're saying that in the last 10 years, there has been no bond which has defaulted, 0%. So last 10 years, no AAA rated by CRISIL has defaulted. Now we come to the next category, which is a AA rated. In AA rated, they are saying that if a bond was rated AA, in 1 year period of it being rated AA, only 0.05% of the bonds have defaulted, which is a very small number. A AA rated bond, when it was AA rated, in the next 2 years, only 0.18% of the bonds have defaulted. And similarly, for 3 years, only 0.3% of bonds have defaulted. Similarly, as you go down the rating scale, A rated, 1 year may only 0.07% defaults, 2 years may only 0.3%. But look at this, as you come down the rating scale, triple B may in 2 years 1.4% of your bonds have defaulted. So when you look at a triple B rated company and say, hey, this is giving me 12.5% kind of returns, and stablebonds.in or other OBPs are only giving 11.5%, you need to look at the risk that is associated with the triple B rated bond. 1.5%. So if you buy 100 bonds, 1.5% bonds are going to go down. So that is a risk that is embedded into your bonds. So as the rating goes down, the interest paid by the bonds go up and the risk of the bonds also go up. For example, CRISIL C, in 2 years, 40% of the companies have defaulted. In 3 years, 50% of the companies have defaulted. And there's an interesting correlation, right? Why does, with increasing time, there is an increasing probability of default? Let's take a larger example. So let's say something like a Reliance. We could be absolutely sure that in the next 10 years, there is nothing that is going to happen Reliance. I would lend my money easily to Reliance. It's a AAA rated company, the biggest of in India. There is no risk of me losing capital. But if somebody were to ask, would you lend your money for 200 years? 200 years is a significantly long period where there is so much uncertainty that I'm not sure. A, I would not be alive, but B, for the next generations to get money, the uncertainty is so high because in 200, I think in history there are very few companies that have survived for such a large amount of time. So as the time keeps going up, as the tenure of the bond keeps going up, the probability of default of this bond also keeps going up. So for you as an investor, whenever you are looking to purchase bonds, keep a watch A on the rating and B on the tenor. Don't get swayed away by longer tenures giving you good returns. It's better off to invest in shorter tenors and then keep refreshing that bonds instead of purchasing for longer tenors.
I think, Harish, there's an interesting question because we mentioned a lot about A, AA, AAA, and tenure. A couple of questions that are coming in that they've gone to apps and they've seen plus and minus, A plus and A minus.
Yeah.
A lot of investors also ask us, is minus very bad in general? So how do you explain that?
So the broad categories are AAA, AA, and A. Now, if a rating agency were to say that even though this company is rated in the A category, it is slightly closer to AA, than A, then they would give an A plus rating. And if there is a bond which is rated in the A category and it's like it's 30% close to A and 70% close to 70% close to A and 30% close to triple B, maybe they'll give you an A minus. So it's just they're creating those granularity in between to differentiate companies which are rated within a category. But be rest assured that an A minus rated company is far better than a triple B rated company. So A minus, A and A plus are far better than triple B companies. And between these, there's a stack rank that is being created that A plus is better than A is better than A minus. And double A is, of course, much better than an A plus. Okay. So an interesting tip, from the last table is that an A-rated company for 1 year is as risky or as low risk as a double A-rated company for a 2 year, or an A-rated company for 2 years is as risky or as low risk as a double A-rated company for 3 years. So for you as an investor, if an A-rated company is giving you better returns than a double A-rated company, but the A-rated is coming at a much shorter tenor, you would be better off by buying that A-rated shorter tenor. After the tenor, then reassess the company, relook at their credit ratings. If it's still A, and then put money again, and then you keep refreshing. So you can play on the tenor and credit rating to make higher returns, and in the credit risk, you could be at a very similar, default rate. So the second thing, so the first thing that you look at is the rating, which is given by these rating agencies, and these are typically on the entities. And the second thing that you look at a bond is the collateral. Again, when you take a loan, you get a home loan at 8.5%, but you get a personal loan at 12%, right? Because in a home loan, you have a collateral which is given to the bank. So the bank feels much safer when giving you a home loan, because even if you don't pay, they can collect your home. Or similarly, in case of a gold loan is much cheaper than a personal loan, because the bank is like, okay, even if he doesn't pay, I'll recover from his gold. Similarly, in a bonds also, there is something called as secured bonds and unsecured bonds. In secured bonds, the company which is issuing the bonds is putting a security against it. So it could very well be a factory or an asset of the company saying that, hey, I am raising 1,000 crore from the bond market, and here is a factory that I am putting as collateral. So if I am not in a position to pay back, you as bondholders have the opportunity to sell this factory off and get that money out. And typically there are trustees in between which try to help these bondholders by selling the assets and giving it back. And there are again two broad categories of corporates which raise money. One is NBFC, the other is other corporates. For NBFCs, typically the collateral is the loans that they give out. So for example, a gold loan company would have given out loans worth 100 crores in the market. When they are raising debt of 1 crore rupee, they will give a 1.5 crore rupee of loans as collateral. And whenever the company is not in a position to pay, you could sell those loans off to another financial institution and recover that money. And after the collateral, the other thing is the stack rank of the collateral, which is the security rating of bonds. So when a company goes down or goes default, there is a stack rank in which the instrument holders are paid, right? The highest category of users that get paid first is holders of senior secured bonds, right? So bond holders anyways get paid before equity holders. Within the bond holders, secured bond holders get first, and within secured bond holders, senior secured bond holders get paid first. Senior means just seniority in terms of repayment. Almost all bonds which are sold on stablebonds.in would be senior secured kind of bonds, and the rank would be senior secured, and then unsecured loan. Then there is convertible debt, which could be converted into equities, in this preference equity, and then equity shares is the rank in which you get paid. So what are the best ways to invest for you as investors is look at the rating, and something over A rating is a good entry point for you to invest in, because the default risk is only 0.1 0.2%. B, look at the security of the bond. It should be there should be collateral, meaning secured. Senior secured is much better, look at the tenor of the bonds, because you're just entering into the bond markets. It's better to hold lower term bonds where the risk is lower, and then you should also only go for securities which are rated by these well-known credit rating agencies, because the lower rung of credit rating agencies, a, there is not much of a track record, and b, we don't know what the shady stuff goes behind. So it's good to have reputed credit rating agencies like maybe a CRISIL, ICRA, India Ratings, CARE. These are the kind of rating agencies that you should look at when you purchase bonds. And just I want to go back to the default study slide. So one more thing that we need to note here is a default is a miss in payment of interest even by a day. So if there is a company which were to pay interest on 22nd of Feb, but they did not pay till 23rd and they paid on 23rd, even that would be categorized as a default. So these 0.18, 0.3%, that defaults that we are looking at are miss of payments by the company even after this. So let's say 0.2% of the companies have defaulted. After that, there are ways through collateral, or maybe the company has recovered and paid back, etc. So the loss of capital is slightly lower than this 0.18%. So even after default, typically 60 to 70% of the money has gotten paid back in the previous default studies. Yeah. How do you invest in bonds? So SEBI has started issuing the OBPP licenses, which is an online bond platform licenses to players like us, stablebonds.in, which can list these bonds. So typically how it happens is players like us filter the bonds available in the market based on the on the risk of the bonds, the rating of the bonds, all the four parameters that I had shown to you. Typically companies like stablebonds.in have risk teams within the company which filter these bonds out. Maybe they look at 100 companies, and after that they bring it down to 10 companies, and those bonds are issued on the websites. And stablebonds.in is one of such OBPs, where you'll have a bouquet of options, maybe 10, 15 bonds available in the market. And there, to purchase a bond, first you would need to do your KYC, and while doing the KYC, you provide your demat account number. You could have your trading account with maybe a Zerodha or a Grow, where a demat ID would be generated. That demat ID needs to be given to the OBP, so that whenever you purchase the bonds come in dematerialized units into your demat ID. So today you purchase a bond on stablebonds.in. By tomorrow or day after tomorrow, the bonds come back into your demat ID. And this is important because think of the issuer, the company that has issued bonds, because they need to pay interest every month. They will go to the depository and ask, this month, who are the users that are holding our bonds? And the depositors would say, hey, here are 100 users that are holding in your bonds. Your bonds are in their demat IDs, and that's how the company would know whom to pay, and therefore the company pays. So to purchase a bond, you do the KYC, you provide as your demat ID, and then you select the bond that you want to invest in, and you make the payment. The payment directly goes to the clearing corporation, which could be NSE's clearing corporation or Indian Clearing Corporation Limited. And we as OBP send bonds to the clearing corporation. The clearing corporation matches that the money has come and the bonds have come, and only then it interchanges. It sends money to us, and it sends the bonds to your demat ID. So therefore, the chances of fraud is extremely minimalized given the OBP framework that SEBI has brought in a couple of years back.
Harish, I think there are two questions whenever coming to the entire demat bit.
Yeah.
One is, why is demat required? I think that you've explained, because it helps us clear the securities in general.
Yeah.
And the second part is, do I need to have a demat right now? Like, what do you say? Can I just link any existing demat? How do I link that? Right. Okay. That's one question that comes. 16 digit, 14 digit. What is it?
Okay. So you need to have one demat ID available with you, but it need not be a demat generated by stable broking. It could be a demat generated by any of your DPs or trading members. It could be by Zerodha, it could be by Grow, or it could be by Angel One. Anywhere, if you have a trading account, that Demat ID can be given to us. But that Demat ID has to belong to the user, because the KYC rules mandate that the user that is purchasing the bonds, only into his or her Demat the Demats need to go. And there is also this problem where some of our users do not have a Demat ID, and for that we just obtained the depository participant license. So in the next month or so, stable bonds.in will start opening Demat accounts for you, which will help make this process more seamless.
Yes, I think because that was the next question by Mr. Venkat, right? So that's answered.
Mr. Venkat, please wait for 1 month and we'll open this up for you. Okay. Withdrawal of bonds. So one crucial difference between FDs and bonds is, in FDs, you can prematurely withdraw your FD at any point in time, right? There is the bank which would pay you lower rate of interest, but any day you could just withdraw at a click of a button on stable money. You can withdraw your FDs, your money comes back instantaneously, or maybe in the next 1 day. In bonds, it is slightly tougher because you need to sell your bond to somebody else. The issuer will not take the bond. And the bond markets in India are typically not very liquid, even though these are listed bonds that we are selling. But if you are go to the market to sell these bonds, there will be a 5 to 10% kind of spread in the market. So typically, until now, bonds was an instrument that you buy and hold till maturity, especially corporate bond for retail. For a corporate which is holding like 5 or 10 crore worth of bonds, it becomes easier because there is a broker network in between where you could go and sell. But for small ticket holders, illiquidity was a major issue. But stable bonds is working on something. We're excited to show that to you. Maybe in the next 2 months, there would be a solution which can offer you instant or seamless liquidity for bonds.
Okay. I think one common question, Harish, which is coming in is the fact that, again, about the security aspect, right? Like FDs have 5 lakh DICGC. Are users asking, does it mean if a company defaults, does it go to zero, or what is it? Is there some security backing it? I think we need to just help that out.
Absolutely. I think DICGC is a game changer for FDs. In bonds, unfortunately, there is no such thing. But in bonds, there are other things, right? You have the collateral when that the company provides. When the bond is issued, there is also the seniority rating in the collateral. So the bonds that are issued by that are sold by us are typically senior secured collateralized bonds. So default meaning is that the interest payout has been missed by 1 day by the company. Now the next steps of recovering the money starts. Typically, whenever bonds are issued, there is a trustee that sits in between the company and the bondholders. The trustee's job is to make sure that the bondholders' interests are protected. Whenever there is a default, the trustee gets into action. They would check for the collateral of these bonds. They would try to liquidate that collateral and pay to the users. And typically, whenever there is a default, given the history, 60, 70, 80% of your principal gets paid back, but it is often laden with delays, etc. So it does not go to zero. There's a good chance that most of or majority of your money will come back if it's a senior secured bond, but it'll take time. Okay. The last question is on the taxation of bonds. So how you gain on bonds is basically through two things. One is interest, the other is capital gains. So let's say there is a bond of face value 100 rupees, but you only purchased it at 90 rupees, right? So at the end of the tenor, the company will pay you 100 rupees. So this 100 minus 90, which is that 10 rupees, would be termed as capital gains. And for the period where you're holding the bond, the interest payouts on the face value that the company makes would be termed as interest. So the interest of the bond would be added to your tax slab and you would be taxed as usual. And interestingly, up to 12.5 lakhs, now you get the taxation is zero. So bonds would be tax free for a majority of Indians today. Even up to 24 lakhs, your blended tax rate would be 12.5% only. So if your income is 24 lakhs or lower, bonds are taxed better than equities because equities short term is 20%, long term is 12.5%. So bonds are more tax efficient until that point in time. But if you cross 24 lakhs, bonds would become slightly less tax efficient than equities. The interest part added to tax slab. The capital gains part is very similar to how an equity capital gains is taxed. So if the bond is held for more than 1 year, you are charged 12.5%. If the bond is held for less than 1 year, you are charged 20%. That's how the taxation is worked. Apart from this, there is also a TDS which is deducted on the interest. So each time the corporate pays you your interest, 10% TDS is deducted. Very similar to what happens in FDs if your interest exceeds 40,000 or 50,000 from this financial year. And that 10% which is deducted can be adjusted against your tax payments that you make at the end of the year. And if you don't fall within the tax range, you could file your Form 15G, 15H, very similar to FDs, and the company will stop deducting that TDS.
I think while this is not related to TDS, I think Harish, you've covered the taxation part of it on the TDS bit as well as the capital gains. You also covered the entire 12 lakh and how it's blended also better in general. One question which is not related to this, but we'll take that. What's the TAT for getting bonds in the demat account post purchase? Here the user has asked stable money platform, but irregular, any platform.
So typically how it works is if you purchase a bond today, the settlement happens on T+1. So let's say you purchase a bond on stablebonds.in before 4:30 p.m. That is when the exchange closes. Before 4:30 p.m. if you purchase, the settlement happens the next day, T+1, next working day of the exchange, T+1, and by T+1 end of day, you'll get bonds into the system.
Okay.
So leaving out 22nd and 23rd, which is Saturday and Sunday, if you purchase bonds on 24th, which is a Monday, by 25th end of day, it will be in your demat account.
Understood. One more question, I think, again, while this is related to the OBPP, but I'll just broaden it.
Yeah.
Sometimes bonds available in stable money can't be bought from open market, even though it's a listed bond, right? Why is that?
Okay. So by open market, we mean stock exchanges. So let's say there is a publicly listed company, Mass Financial, for example. It's a publicly listed company. Its bonds are listed on stablebonds.in. There's only one equity share or one kind of equity share that trades on the stock market, but they would have issued like 100 bonds till now, right? So the number of bond instruments in the market are so high that there can't be liquidity. There can't be enough buyers and sellers in each of those instruments on the stock market. So therefore, bonds are typically not very liquid. Bonds are liquid for institutional players, people who buy bonds for more than 5 crore rupees. There is a broker network which runs within the country where you could go and seamlessly sell. So what stablebonds.in does is it goes to that market where it's traded in bulk, 5 crore and sizes, purchase from there and bring it to you and make it liquid to you. That's how it works.
Understood. There's a question, what is, in your suggestion, right, what is the most relevant option for emergency funds? Is it bonds or FD?
As of now, I think FDs would be better because the liquidity is an issue. Emergency fund has to be extremely liquid. But 2 months down the line, whenever we bring the option to give you instant liquidity, then perhaps bonds.
Okay. Again, I think this TDS and other things are important. So please elaborate on how to recover TDS if I do not fall under the tax slab.
So the simplest thing that you could do if you don't fall under the tax slab is file 15G, 15H. There are links provided on the stable bonds website. Also, you could reach out to us. We'll help you with the links where you could upload these documents and it will be sent to the issuer of the bonds and they'll stop deducting that TDS. But if the TDS is paid, then you would have to do a tax filing at the end of the year and say that my income is less than 12 lakh rupees and the government would refund the tax back to you.
Okay, sure.
Okay, and in the last slide, we'll cover, there are these categories of, fixed income instruments, right? There is debt funds in the market, there's FDs in the markets, there's bonds in the market. What is the use case, for each of them? I think whenever you're building your investment portfolio, you should start with the extremely low risk and okay return kind of products first, right? First, you meet your requirements like an emergency fund or capital that will grow but at a consistent pace. So FDs would be the first thing that you would need to invest in whenever you're building a portfolio. Let's say you build a small portfolio for FDs, then bonds is a step up from that investment where your risk is not going up significantly. As we've seen, an A-rated company with a 1 year or a 2 year tenor has only 0.1% kind of default rate. At such a low risk, you can get 2% higher, right? 11.5%, kind of instrument where you're just starting to get into higher risk, higher return kind of products. So you do FDs first, then bonds next, and then go on to higher risk, higher return products. There's also an interesting debt fund, category that comes in between, which is the debt mutual funds in the market. These had a tremendous use case 2 years down the line where there were indexation tax benefits, where post tax these debt funds used to make a lot of sense. But these days it doesn't make a lot of sense because it is taxed like FDs. They'll give you lower return than FDs, and these are typically open-ended, debt mutual funds where you can't say with certainty what your return is going to be 1 year down the line, because with changing repo rate, your return on the debt funds can go up and down. So if you were to look at these three, I would say build your portfolio with FDs. Once you hit a certain size, start putting some money into bonds. For people on stable money, I'd recommend maybe try bonds with 10%, 15%, very small quantities, and as you gain confidence, start looking at returns is when you can scale up.
Okay. While I think that brings us to the end of like a quick glimpse, right, of what bonds are, or to simplify it. I think we'll still take time if there are some open questions, etc., which users, everyone can actually start telling. Can we buy bonds in multiple demat accounts?
As of now, we take one demat account from you. So on an OBP, you can only buy from one demat account, but you can change that. So for example, you had given your Zerodha demat account today, and 1 month down the line say, I want to purchase bonds on a different demat account. You can update us. You can provide the relevant proofs. We'll update it. So the next one can be purchased on that demat account.
Another question, since you mentioned about portfolio approach, right? Like, what should be the ideal allocation percentage for bonds in one's portfolio?
That's a tricky question because it depends on the risk tolerance for you. But for somebody like me, in my fixed income portfolio, around 40% would be bonds and 60% would be FDs. As I said, if you're starting off on investment, be focused towards FDs. If you're a mature investor, maybe have spent 1-2 years on FDs and then start increasing FDs, increasing the share of bonds.
Okay. I think this is again one common question, and I'll actually take it. In demat accounts, why do bonds value not get updated? Because a lot of users after investing think, my values are not updating.
Yeah, so it's very easy for equity values to get updated because equities are very liquid, and stock exchange publishes the daily closing price of those bonds, and you can just match it against it. But for bonds, because they are not traded actively on the stock exchanges do not have an active price to give. Therefore, the DPs or your trading member does not know what price the bond is at, and therefore it does not get updated. But if you're an OBP, if Stable Broking, stablebonds.in were to open a demat account for you, we would know where that bond is priced, and we would be able to show you that. So 1 month, 2 months down the line, this problem will get solved for most of you.
Understood. I think there's a question on HUF that keeps coming.
Yeah. I know we haven't done a good job at enabling bond investments for HUFs, but our team is working on it. The KYC process would not be as seamless as the KYC for individuals, but we're working on it. There should be something there shortly.
Okay. While I know this answer, but still, can 2 or 3 people buy a single bond, fractional bond?
No, as of now, that's not allowed. Fractionalization of bonds is not allowed. Each person can only buy, 1 unit at the minimum. But the good thing is, stablebonds.in, for example, has bonds ranging from 100 rupees. So there's no need for fractionalization when you can buy bonds in such small units.
Okay. And do global interest rate movements, and in fact, one previous question, right? When RBI cuts repo rates, etc., what happens to bonds?
So see, bonds are again issued by corporates and the government of India. for corporates, there are two sources of capital. They could either come to banks or to the corporate bonds market. So if banks start becoming more competitive, corporate bonds will not. So they won't issue a lot of corporate bonds, or even if they issue the corporate bonds, they'll be at a lower yield. When banks are not competitive, these guys will issue more corporate bonds at a higher yield. So the interest rate in the banking environment will definitely impact the interest rate in the bonds environment. But the only thing is bonds work on an expectation basis. FDs work on an actual basis. What I mean by that is, in February there was a repo rate cut of 25 basis points, and most FDs, I think, will start to fall by 25 bips very soon after the repo rate. But bonds, the yields have fallen 2 months in advance because everybody knows that there is going to be a repo rate cut. And these are actively traded, so it works on expectations. So bonds would be a leading indicator of where the interest rates would be. Banks would be a lagging indicator, but they move in sync.
Okay. Can we get a physical copy of a bond after buying on stable money? And I think secondly, is it even needed?
It's not needed because it is going into your demat account. Think of you purchasing an equity stock, right? It only goes into your demat account. So it's not needed. And as of now, all listed bonds can only be sold through dematerialized form, so you can't get that. Maybe you can get a receipt or a confirmation from the issuer when you purchase in the primary market, and when you purchase through stablebonds.in, you get the deal sheet, you get the order receipt where we show the details of the bonds. You have a physical proof that I've purchased this bond, but the actual bond would be sitting in your demat account.
Understood. I think in general, and this is the last question, and folks will do this again with the PPT working also, right, as such, and we'll send you the PPT. The bigger question, right, like as such, does stable money charge commission for us?
No. So stable money, when we are bringing bonds to you, do not charge a fees, from you. In fact, even when we bring you the demat ID, we won't charge you a fees. But stable money has other ways of making money for full clarity. For example, if a bond is being sold to you at 11.25%, because we buy in bulk, maybe we get it at a slightly better rate of 11.3%. So that's how there is ways for us to make money, but there is no direct commissions that is charged from you.
Okay. Last question: difference between bonds and NCD as such.
So most corporate bonds that are offered today are NCDs only. These are non-convertible debentures. Bonds is a term that is typically used for government securities, but for corporate, there's no major difference.
Okay. I think, folks, we've covered majority of questions. I know that we've covered a few questions in general, and there are a lot more to be pending. After this, I think at somewhere around the weekend, Sunday or Monday, we'll send out everything that we've learned, all the key questions that have been asked, and we'll send out to all registered participants as well as the PPT, right? Because whatever is said, these are just as simple tips which would get you like 85 to 90% bond investment ready, right? As such for confidence. So, Mr. Somnath, this will be shared, and Mr. Sriram, what is the 16-digit DOID number? Yes.
So this is the demat ID. Mr. Sriram, if you have, let's say, a trading account with Zerodha or a Grow, there is a demat ID that would be generated against you, which would be available. All your bonds will be sent to this demat account. Is very similar to your bank account. Your money goes into your bank account. Your stocks and bonds go into your demat account. So this is like the bank account number. This is the version of your demat identification number. So this should be available on your trading platform. If you share that with us while onboarding, that is where the bonds will be sent.
Okay. And while I've been mentioning last, I think just the last question. Okay. Do you purchase a portion of bonds to give confidence?
Absolutely. So all bonds that are sold on the stable money, we do hold some part of it on our portfolio. It could be either on in my account or Saurabh's account personally, or in the company's account. But one of the relevant parties will have these things.
And is it a good time to buy bonds given the high interest rates?
Yeah, I think because in the next 2 years there is a rate decline expected. I think it looks like a good time to buy bonds, and there is also a general loss of confidence in the equity markets as well. So we see some money moving into the bonds market, but rather than timing these things, it's good to stick to portfolio allocation and then keep working with it.
Okay. I think that's it, folks. We'll wrap it up for now. And Harish, any closing notes?
No. Thanks a lot, guys. We're so sorry for the technical difficulties. We'll try to make this up next time. Thanks a lot for joining this.
Thank you. Thanks, everyone.
Right.